Be honest with me for a second. Have you ever watched the news? Seen the market crashing? Everybody's panicking? Your portfolio is bleeding red? And you just froze? You didn't know whether to sell everything, buy more, or just close the app and pretend it wasn't happening? Or maybe the opposite. The market's been going up for 2 years straight. Your neighbor's bragging about how much money he made on stocks, and suddenly you're throwing money in at the absolute worst time, right before it all falls apart. Look, that's not stupidity. That's not bad luck. That is what happens when you're playing a game without knowing the rules. And here's the thing. The rules exist. The economy moves in patterns. It always has. And the people who understand those patterns, they're not smarter than you. They're just earlier than you. Today, I'm going to change that. Ciao. Welcome back. And if you're new here, this channel is about building real, lasting wealth through financial education that actually makes sense. My name is Tom, and I've spent over 2 decades studying markets, economic history, and the psychology of why people make the financial decisions they do. And one of the single most underused concepts in personal investing is something that professional fund managers, central banks, and institutional investors use every single day. It's called the economic cycle, and once you understand it, you will never look at the market the same way again. If you're someone who feels like you're working hard but not making real financial progress, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Let's get into it. The problem. Why most investors lose. Here is what most people don't realize. According to a long-running study by the research firm Dalbar, the average retail investor, that's people like you and me, has historically earned significantly less than the market itself. Over a 30-year period, while the S&P 500 returned around 10 to 11% annually, the average investor captured only about 3 to 4%. Why? Not because they picked bad stocks, not because of fees, but because of timing. They bought high, sold low, panicked at the wrong moments, and celebrated at the wrong moments. Think about that. The market was sitting there, delivering 10% a year, and most people turned it into 3-4%. That's the equivalent of someone handing you a Ferrari and you driving it in first gear the entire time. So what causes this? It's not just emotion, although emotion plays a massive role, and we'll get to that. The root problem is that most people have no framework for where we are in the economic cycle. They react to headlines instead of patterns. They see a crash and think the world is ending. They see a bull market and think it'll last forever. Neither is true. And the economic cycle is your roadmap to understanding why. What is the economic cycle? All right, let's break this down simply. The economy doesn't move in a straight line. It moves in a cycle, and that cycle has 4 distinct phases. Phase 1, expansion. The economy is growing. Jobs are being created. Companies are reporting strong earnings. Consumers are spending confidently. Credit is easy to get. The stock market is generally climbing. People feel rich. Phase 2, peak. This is the top. Growth is still happening, but it's slowing. Inflation starts rising. Interest rates climb as central banks try to cool things down. Asset prices are at their highest. This is where, and pay close attention, most retail investors are most excited. Phase 3, contraction. Growth slows sharply. Unemployment rises. Corporate profits fall. The stock market drops, sometimes dramatically. Credit becomes tight. Consumer confidence collapses. This is where most retail investors panic and sell. Phase 4, trough. The bottom. The economy is at its weakest point. Sentiment is terrible. But here's the thing. This is almost always when the best buying opportunities exist. Now you might be thinking, okay, but how do I know which phase we're in? And I get it. It sounds complicated. But stay with me, because this is where it gets really interesting. The indicators. Reading the cycle. Think of the economic cycle like the weather. You can't control it. But if you know how to read the signs, you can prepare for it, and you can use it. There are a handful of key indicators that signal where we are. Interest rates are your first signal. When the Federal Reserve is raising rates aggressively, like they did in 2022 and 2023, that's almost always a sign we're near a peak or entering contraction. When they start cutting rates, they're trying to stimulate a slowing or contracting economy. Historically, the first Fed rate cut has often coincided with the beginning of a market recovery, though with a lag. The yield curve is another big one. When short-term interest rates rise above long-term rates, what's called an inverted yield curve, it has predicted every U.S. recession since the 1950s. Every single one. That's not a coincidence. Unemployment and consumer confidence are lagging indicators. They confirm what's already happening. But watching the direction of these numbers tells you whether contraction is deepening or recovery is beginning. Here's what most people don't realize. You don't need to be perfect with this. You don't need to call the exact day the market bottoms. You just need to be directionally right, and you need to be patient. Let me give you a real-world example. The math of positioning through the cycle. Let's say it's late 2021. Every indicator is flashing peak. The Fed is about to begin its fastest rate hiking cycle in 40 years. Valuations on the S&P 500 are stretched. Price-to-earnings ratios are historically elevated. Consumer sentiment surveys are at multi-year highs. Investor A ignores all this. They're fully invested in growth stocks, riding the wave, feeling incredible. The headlines say the market will keep going up. Investor B recognizes the signals. They don't sell everything. That's not the strategy. But they rebalance. They shift a portion of their portfolio from high-growth, rate-sensitive tech stocks into more defensive sectors. Think utilities, healthcare, consumer staples. They build up a little more cash. They shorten their bond duration to reduce interest rate risk. Now, 2022 hits. The S&P 500 drops approximately 19.4%. The Nasdaq drops nearly 33%. Growth stocks, the ones Investor A was fully loaded in, drop 40, 50, 60%. Investor A's $100,000 portfolio is now worth roughly $65,000 to $75,000, depending on their holdings. Investor B's more defensive positioning means their portfolio drops maybe 8 to 12%. Their $100,000 is now around $88,000 to $92,000. Here's where the math gets powerful. By late 2022 and into 2023, the contraction is showing signs of easing. Investor B has more capital and more psychological stability because they didn't panic, because they understood what was happening. They start gradually increasing their equity exposure as the cycle shifts toward early expansion. That difference in drawdown, let's call it $20,000, doesn't just mean they lost less. It means they have more capital working during the recovery. Over the next 10 years, assuming the market returns to its historical average of roughly 10% annually, that $20,000 difference compounds to over $51,000. The cycle didn't just protect them, it made them money. The psychology. Why we always fight the cycle. Here is the uncomfortable truth. Even if you understand everything I just said, you will still be tempted to fight it. And the reason is psychological. Loss aversion, a concept pioneered by psychologists Kahneman and Tversky, tells us that the pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. So when the market is falling, the emotional pull to sell and stop the pain is almost overwhelming, even when logic says you should be buying. Recency bias makes us assume whatever just happened will keep happening. Markets are up? They'll stay up. Markets are down? They'll never recover. But history, every single bear market in history, says otherwise. Social proof is perhaps the most dangerous. When everyone around you is excited about the market, your coworker, your uncle, the guy at the gym, it feels reckless to be cautious. And when everyone's panicking, going against the crowd feels terrifying. But think about this analogy. If you're on a diet, you know that pizza at midnight is a bad idea. The knowledge doesn't make the craving disappear, but the knowledge combined with a system, is what keeps you on track. The economic cycle is your system. It's not about being emotionless. It's about having a framework that overrides emotion at the critical moments. The practical strategy. So how do you actually apply this? Let me give you 3 concrete actions. 1. Map the current cycle every quarter. Spend 20 minutes. Check the Fed's latest guidance on interest rates. Check the yield curve. Look at unemployment trends and ISM manufacturing data. You're not trying to be a professional economist. You're just trying to ask, early expansion, late expansion, contraction, or trough. 2. Adjust asset allocation, not exit the market. This is critical. You are not trying to time the market perfectly. That's a fool's game. You are adjusting your exposure based on where we are in the cycle. Early expansion? Lean into cyclical stocks, financials, industrials, consumer discretionary. Late cycle? Rotate toward defensive sectors and commodities. Contraction? Increase quality holdings, reduce speculation. 3. Prepare your buying list during the peak. This is the move that separates disciplined investors from reactive ones. During the good times, when you're calm and thinking clearly, make a list of companies you'd love to own at a 30-40% discount. Because when contraction comes and prices drop, that's exactly what you'll have the opportunity to buy. And you'll be ready, emotionally and financially, because you planned for it. The shift in perspective. Look, most people will spend their entire investing lives reacting, buying when it feels safe, selling when it feels scary, wondering why their returns never match what the market supposedly delivers. But you don't have to be that person. Economic cycle is one of the most powerful, most free pieces of knowledge available to any investor. It has repeated, with variations, for literally centuries. It will repeat again. The question is whether you'll be on the right side of it. Warren Buffett once said the investor's worst enemy is often themselves. Understanding the cycle doesn't just improve your returns. It protects you from yourself. Start today. Just this week, take 20 minutes, Google current economic cycle indicators, and start building that mental model. Small action, massive long-term impact. If this video gave you even one insight that changes how you think about investing, do me a favor, hit that like button. It genuinely helps this channel reach more people who need this information. And if you want to keep building this kind of financial intelligence, subscribe. We go deep on wealth building strategy every single week. Knowledge compounds too. Start now. See you in the next one.